On today's hot sheet, I don't know what I'm discussing, but I am pulling it up right now. I'm discussing vacation home demand, single family versus multifamily rent growth, and the producer price index for April. I was reading up on that earlier, and it might just surprise you, or it might not. Today is Tuesday, May the 14th, 2024. I am Byron Lazine, and the hot sheet starts now. Okay, here we go. Two bumpy roads to start the hot sheet this week. Monday with some technical difficulties, and today with some difficulties in me looking at the right sheet. So here we go. To open up the hot sheet, we're talking about demand for vacation home mortgages. Now, I think this is actually really interesting. We know that vacation home mortgages may not impact you in your particular market outside of a one-off here and there, unless you're in a vacation market, second home market. But this is an indication of the consumer overall. The PPI, which we're going to go over later today, is also an indication of where the consumer might be. But this one's interesting. There's only 4 million sales right now for a reason. All of the want to sales, all the want to purchases in the real estate market have essentially evaporated with where affordability is. See, it's not just rates, it's those record prices combined with rates. And there's just not as much liquidity in the market to go around as there was a couple of years ago. This has created a bottoming out of sales. For 2 years now, we've seen historically low sales. The floor seems to be 4 million, which is good. That's the floor we've seen over the last 25 plus years. We don't expect to go below that, but we've been scraping along that line now for a while. That number hasn't shown any indications of going up, all while there's been projections that this year it would. I ask you, is there more sales available in your MLS this year than last year? We know there's more inventory across the country, but are you seeing more sales, more closings, more opportunities to close deals? Your personal business might, but I'm talking about the market. The market hasn't reflected that. And right now we've seen a drop on second home demand when it comes to mortgages. The number of U.S. mortgage originations for second homes by year. Look at 2023. It's not only below the recent years, obviously 20 and 21 were going to be outliers on the positive, but 2023 is also below 2018 and 19. 2018 and 19 are considered normal real estate years, very normal. 2019, especially the year before the pandemic, you could call one of the most normal housing markets across the country. And 2023 experiences many fewer homes, almost half the amount of U.S. mortgage originations for second homes. Now, a lot of this can be fueled by folks who are just using cash. Remember, 40% of home buyers, or at least well over a third of home buyers, are still using cash right now. U.S. home buyers in 2023 took out 90,000 mortgages, which was down 40% from a year earlier and 65% from the height of the pandemic boom, and about half of what we saw in 2019. Mortgages for primary rates fell half of that rate. They were down 20% year over year and down 35%. So we know primary mortgages are down, but what are the moves that are happening? It's those must moves. I've got to do it because of life. I've got to do it because I've got 3 kids and 1 bedroom home. Okay. These are the things that are forcing people into buying right now, which is why mortgages on primary homes are not down nearly as much. It's also more expensive to buy a second home. Typical second home was worth $475,000 in 2023 versus $375,000 for primary homes. The federal government increased loan fees for second homes in 2022. If you remember that, they snuck that extra tax in while everybody was buying these second homes, which upped the total cost of buying one. Vacation homes aren't a necessity, obviously. the way primary homes are. So when these prices do skyrocket, or even, think insurance right now, it's a big conversation. When this goes up, less people are inclined to go out and buy these homes. You might actually see an opportunity to look at who bought second homes in 2022, in 2021, even in 2020. Are they thinking about selling one? I know one of the listings that we have up at the team in Connecticut right now is just that, a second home buyer that bought in 2020, 2021. They're starting to come out of the woodwork a little bit here. They're seeing that maybe the market is loosening up a bit, not cratering or anything like that, just loosening up. And that's leading them to say, maybe I should tap out now. I'm not really using this second home. It seems to be getting more expensive to maintain it and to keep it, not less expensive. Affordability issues, obviously, is one of the things that are driving it. These costs, non-essential nature of second homes is another reason for this decline. Impact of return to office policies. So the use of it, not using it as much. If you weren't needed in the office, you can use your second home all the time. The rental market has also cooled. We talked about yesterday, what are the best markets for short term? My feelings on short term. By the way, I looked into that rental arbitrage. I don't know if I don't like rental arbitrage. I think it's silly. I know a lot of people are probably having success with it, but a lot of people are having success buying crypto and trading meme stocks. Shout out to the what's his name there on the Roaring Kitty, who went on a tweet spree yesterday for 3 years. I actually am interested if anybody in the comments wants to tell me what the GameStop stock did this morning on the open. I'd be curious on that. But we saw what happened with AMC and GameStop. We saw that those, had that little run up and they went crashing down. This rental arbitrage thing, NFTs, where are those now? I don't know. This rental arbitrage thing where you're trying to play the system. To me, just go buy real estate and invest in it. People are saying, well, they're getting money up to go eventually invest in real estate. There's other ways to make money that seem less risky and more practical to me. Okay. If you're cutting it that close where you can't even invest in real estate to make a margin off from one lease to another, the minute one of these tenants screws you, what's going to happen there? Okay. Demographic of the profile of the second home buyers in 2023, going back to this, 86% of second home mortgages were taken out by high income buyers. Obviously makes sense. 76 were white home buyers. 58.1% were Gen Xers aged 45 to 64. This is a Redfin report. Metros with the biggest annual declines in second home mortgages. Okay. Let's go to this in the hot sheet show notes. Austin, Texas, down 62.5% year over year. San Francisco, New York, Seattle, and Nashville. Metros with the smallest annual declines would be St. Louis, Missouri, Kansas City, Missouri, Providence, Montgomery County, Pennsylvania, and Warren, Michigan. Metros where second home mortgages made up the largest share of all mortgages. West Palm Beach, just under 7% of all mortgage originations were second homes. Orlando, Riverside, New Brunswick, and Tampa. How about the smallest share? Would be Detroit, Montgomery County, Pennsylvania, Oakland, Cleveland, and Dallas. Okay, so there's your local summary on these second home reports. Ultimately, second homes have declined. Just 2.8% of all mortgage originations in 2023 were for second homes, down from 3.6%. Second homes on the decline. This tells me it's an opportunity to use PropStream or something like that to go after second home owners. By the way, Bobby, if you can, we have a link for PropStream with BAM. It gets you the best house for PropStream. It's where I get all of my data for stuff like this. If you don't mind, Bobby, putting that into the live chat and then maybe putting it into the the show notes down below. They are not the show notes, but the just the YouTube description as well down below. Check out PropStream if you're looking for information like that. All right, single family versus multifamily rent growth. We know that rents are cooling, but which one is cooling more? National single family rents rose by 5% between March 23 and March 2024. This is according to a new report on Resi Club, highlighting the difference between rent growth between single family and multifamily. Multifamily rents increased only 2.7% during that same time period. Why did multifamilies increase less? Well, there's a strong desire, obviously, for single family rents, but also there's an abundance of multifamily rents. They've been building these across the country and they've been coming online the last couple of years, and they're continuing to come online this year at one of the largest rates ever. Single family rent growth reached 13.4% year over year on March 2022 during the housing boom, and multifamily had peaked out at 16.3 during that same time frame. The surge in multifamily completions that I mentioned, U.S. completed over 439,000 new apartment units, marking the highest level of new supply since 1987. That was just last year. This year is supposed to surpass that and reach the highest level since 1974. 671,000 plus units will be completed in 2024. If you don't think rents are coming down with that much supply hitting the market, certainly in these markets where it's hitting, you're kidding yourself, especially on the multifamily rents. It's also another reason I'm skeptical for people that really don't understand the long-term return versus short-term. Everybody's talking about cash flow. I want cash flow. Good luck, buying in one of these markets where there's 670,000 of these new, beautiful brand new apartments coming online. And you're going to buy a crappy 3-family and expect cash flow. Long-term appreciation, yes. Lucky to break even, yes. Okay. Investing in real estate's a beautiful thing. You need to set expectations. It comes down to being obviously having somebody in your corner educating you on what that's all about. Cities like Austin and San Antonio are experiencing the most significant increases in supply, and they're also seeing declines in multifamily rents. There you go. I expect a lot more of that this year. Multifamily market softness is attributed to the wave of new apartment completions. Those were financed during ultra low rates. There's going to be a slowdown in these starts, and there already has been. We're already talking about not only below pre-pandemic starts, but we're talking really low housing starts on multifamily, starts. Okay. Anything else on that? There's plenty, obviously, to dig into in your hot sheet show notes on that. Here's the rent change that I've been talking about for a while now. This has been going on. Significant rent change here. This is sourced from the Zillow Observed Rent Index, flattening of rent growth, which is good for inflation long term. We'll hopefully start to see it reflect in the inflation numbers. Speaking of those, we got a new report this morning. Wholesale prices, otherwise known as PPI, rose 0.5% in April, and the headline reads, more than expected. It's another roadblock for interest rate cuts coming anytime soon. Okay. Here's straight out of the Bureau of Labor Statistics. As you can see, the 1-month percent changes in PPI final demand going now up. The 12-month percent changes in PPI not really moving all that much. And on the 12-month look, we're right at above 2% on PPI. So it's not world ending, but again, it's more than expected. It's another reason why just one small little data point why the Fed might continue to pause here as opposed to a cut in the near future. The PPI for final demand, which went up to 0.5% in April. There was a decline of 0.1% in March and an increase of 0.6% in February. PPI for final demand rose 2.2% over the 12 months ending April 24, marking the largest increase since a 2.3% rise 12 months ending April 2023. So interesting, this April now and last April are the highest, year over year indicators. So maybe there's something to that. We'll consider that obviously as we go to next month and see where it comes in next month. I did take a look at the 10-year, obviously, to see how the 10-year reacted. And it looks like expectations or reaction with the market here shot up on the news, but then not only came back down, but below where it was trending before. So we're under 4.5 on the 10-year. Markets don't seem to be overreacting to this, so I wouldn't either. 4.461 on the 10-year. I'll take that. Yesterday, with the 10-year kind of hanging around there, we saw a slight dip in the 30-year fix. We're trending back to an even 7 here. Let's keep the momentum going. We're at 7.12 to start the week yesterday after a 7.16 to end the week last week. Where you want to be midweek this Wednesday at 3 o'clock is with myself and Brian Boero on a free BAM webinar. Right now is the ultimate time, probably the biggest opportunity for any of us to build brand with everything that is changing. Myself and Brian Boero are going to go through exactly what steps you should take in the next 90 days to build brand. That's going to be a free webinar tomorrow at 3 o'clock. We'll put the link down below so that you can make sure you are there. Brian Boero and 1000 Watt have consulted on brands like Zillow, of many of the Anywhere brands or biggest brands in the brokerages that you are accustomed to today. They did not consult Anywhere. I want to make that clear. They did not consult Realogy from going from Realogy to Anywhere. I'm talking about the brands that live on some of the Sotheby's brands, some of these types of brands. They would have had other ideas about Anywhere. Not that if you like that name, I'm sorry for that. But think Zillow, think Curator, think Picasso, think some of these amazing brands. They've obviously consulted on all of that. They're brilliant. The company Mark Davison and Brian Boero have co-founded together. And Brian is going to be joining me tomorrow, 3 p.m. Eastern, free BAM webinar, as we talk about the single greatest brand building opportunity in the market for real estate agents right now. We'll link that up so you can obviously take a look. I don't see Bobby linking it up. Bobby, are you struggling with that? Do you need me to send it to you, Bobby? I can send it to you, Bobby, because I don't see it. I don't know if Bobby fell asleep here. He's got a lot going on, but I still don't see it. We'll get it linked. There it is. There it is. Bobby. Hey, Bobby. Bobby now has it linked up. The 1000 Watt brand and oh no, that's the brand and marketing summit, Bobby. That is not the webinar. The webinar tomorrow. Let me get it over to you. Although, oh, here it is. It's actually right in our text group, Bobby. So I don't need to get it to you. It's right in our, there it is. Thank you, Bobby. Way to go. All right. Join me tomorrow at the webinar. We'll obviously put it in the description below if you're listening to this on the replay. Later today, we will have a new Real Word podcast going up on the channel around 2 o'clock. Make sure you're subscribed here to the @NowBAM YouTube channel. Hit the notification bell. I'll see you guys over on Real Word later in the day, as well as back here tomorrow morning for the hot sheet. Until then, toodaloo.